region or country. We also need to look at the stability of their politics. And now let me show you the market performance as of 12 June. This is the market performance as of 12 June. As you can see, China, Malaysia, South Korea, Japan, and the US almost bounced back from to its origin. So on the other hand, Indonesia, Russia, Brazil, and India are still suffering because COVID-19 continue to outbreak in their country. Now let us do a comparison between these two charts. Okay, please take note that the red dots represent the data for 12 June. So from this chart, you can see clearly that most of the market has recovered from its trough. If you bought any unit trust or stock in March, I believe you have made a very good profit from them. This is global market performance as of 5th June. The blue color line represents Standard & Poor's 500 index, and green represents MSCI World Index. So from this chart, we can see that global equities have rallied notably over the past few weeks. A better than expected US job data helped the Standard & Poor's erase all the year-to-date losses and send the Nasdaq index to all-time highs. On the other hand, MSCI and World Index also bounced back quite a lot. It has posted a strong recovery from its negative 31.8% drawdown back in March. So after showing you all the market performance, now I'm going to share with you the market P/E ratio. The P/E ratio helps investors determine the market value as compared to its earnings. So from valuation perspective, if current P/E ratio is lower than its fair PE, it means that the equity might be selling at attractive price now. So as you can see, most of the markets are still selling under its fair P/E ratio at this junction because of the uncertainties ahead. So for investors who are seeking long-term growth opportunities, we think Asia and emerging markets are attractive avenues to consider. Within equities, we are maintaining a positive view on Chinese equities as the nation remains on track to emerge from COVID-19 crisis with ample policy space to mitigate those unforeseen uncertainties. So with equity markets rebounding strongly from their March lows, it may be a good time for investors to review their portfolio. So for those who have invested into equity fund in March or April, I think it is time to rebalance your portfolio as the valuation have crept higher on the equities part. You may consider to trim the excess equity exposure and relocate those back into fixed income fund. So overall, the global market is so volatile this year. So after I show you the market performance, I believe some investors might regret, why don't they invest when market drop? I think it is normal because the market sentiment has affected your emotion during that period. Most of the people are the same. So from the graph I showed you just now, we know that it is normal for the market to go up and down. When it goes up and reaches its peak, the tendency to go down might be higher. It may be due to correction or profit taking. This is the same to the market that are facing downturn. When the market drops to a certain level and making the valuation attractive, investors may start to buy in, and it may eventually push up the market. So basically, this is the nature of the market. I think most of us have seen this quote before. So if you want to make money in financial market, we need to be a contrarian. We have to think oppositely and act oppositely when most of the people are fearful and panic sell their holdings. However, it is still fine if you miss the huge gain in these few weeks. We think we need to move on and think what else we can do to your current holdings. So today I will be sharing on one of the investment strategies called rebalancing. I think it is very important for investors to make adjustment on their portfolio allocation on a regular basis to adhere to different market situation. So what is rebalancing? So basically, it is a strategy that realigning the allocation of your portfolio of assets. It involves buying and selling of the asset to adjust it to the desired allocation periodically. The adjustment can be every quarter or every year. So in FSM1, we advocate a portfolio investment strategy. We believe that it will be better to have multiple funds that investing into different markets and asset classes. So if there is losses from one region asset, it will not have a significant adverse impact on your overall portfolio performance. Let's see the example. This is our simple allocation for moderately aggressive portfolio with 70% in equities and 30% in fixed income fund. Assuming you have allocation in Malaysia equity, Asia equity, and developed market equity, as well as a local fixed income fund. And the allocation actually is based on your risk appetite. If you think you are a very conservative investor, you may reduce the percentage in equity. Now, we assume that the Asian market was performing good and the rest of market dropped slightly in 1 year period. So after 1 year, your portfolio might be looking like this. The outperforming funds from Asian market will have increased in allocation. On the other hand, markets that are relatively slower will have lesser allocation. So what you need to do now is to revert the allocation back to your initial desired allocation, which is 70% in equity and 30% in fixed income. So one of the biggest advantages to do so is that you might avoid to buy high and sell low because you are following a systematic approach. Normally, I suggest my client to create a table like this and list down all your funds and categorize them based on a geographical region as well as different asset classes such as equity and fixed income. Also, list down the latest value of each fund and calculate the latest allocation in percentage. By doing so, you will know what is the shortfall between the current allocation and the targeted allocation. Then you will be able to see what is the amount you have to buy or sell in order to do the rebalancing. To sell the funds, you may take the amount divided by the latest NAV. You will roughly know how many units you need to sell. Investor may then ask, selling and buying of the funds and adjust it to the original allocation. It sounds easy, but why do we need to do so? So the main reason we do rebalancing is to help you to reduce the downside risk. As I mentioned earlier, market has its ups and downs. Those up one will increase your allocation in the portfolio, while those that drop will decrease. So hence, for example, you have done your risk assessment and found out that you are a balanced risk investor. You can accept investing 50% in higher risk investments such as equity fund and 50% in fixed income fund. After 1 year, assuming the equity fund performing very well, and the equity part will increase to 65%. But because you are so happy that you earn a lot during the 1 year period, and you decided to leave it like this and do not do anything about it, you are actually expose yourself to higher risk, because in this case, you are investing 65% into equity fund, which is above your risk tolerance level. Therefore, we assume the market, thereafter, if we assume the market continue going up, of course, we will be happier. But we always need to be prepared for the worst. If the market goes against your prediction, you may suffer more than you can accept. So a lot of investors would feel panic and sell all their holdings when the market is going down, like what happened in March. This is because they invest exceeding their risk level. Therefore, with rebalancing, you adjust it on a regular basis. You are exposing to the risk that you can accept. So in the worst case, the chances for you to sustain the investment is higher. And if you can sustain, it increases the chance for your portfolio return to recover. Let me show you a real life example. This is a balanced portfolio. We invested USD 10,000 where 50% into world equity index and another 50% in bond index. The red line shows the portfolio that rebalance annually, while the blue one is without rebalancing. So if you notice, the moving pattern is actually similar, but the volatility of the portfolio is totally different. The rebalanced portfolio showing 8.4% of volatility, while the non-rebalanced portfolio exposed with higher volatility of 8.7%. Besides, the rebalanced portfolio has an annualized return of 7%, while the non-rebalanced portfolio has only 6.1%. After 20 years of investments, it shows the rebalanced portfolio has over USD 20,000 as compared to USD 18,000 without rebalancing. To be frank, rebalancing does not help you to generate higher returns or better performance all the time. However, it does help on lowering down your portfolio volatility. This will be more significant if the investment horizon is longer, say 25 years or 30 years. Secondly, it helps to enforce a discipline in your investment. There's one thing in investment that a lot of investors cannot overcome and hard to change. It's called emotional investment style. So when the fund is doing good, investor will be very happy. However, if the fund is dropping, most of the investors will feel nervous and choose to sell at the end. That is because the fear of losing let the emotion come in and interrupt your investment decision. And this happens more often if you only have one or two funds in your portfolio. That is why we strongly advise clients to invest in a portfolio way. So if you're implementing a portfolio investment strategy and doing rebalancing systematically, you don't need to worry that much when the market goes opposite, because you have set your strategy from the first day you invested, and you clearly know that what you are doing. With the strategy, you may reduce the chance of panic selling. Just like this graph, most of the investors are excited when the market is going up and start to buy in. However, they don't know it is actually more risky for them to enter at the point. Conversely, they feel panic when the market is selling at attractive price. It is very normal at the market because most of the investors are risk averse. They cannot accept short-term fluctuation. That is why most of them will end up with buy high and sell low and end up losing money. Last but not least, rebalancing helps you understand more about your investment portfolio. I'm not sure if you have understanding on your investment, like why you buy this fund. Is it you see the performance of the fund recently is good, or maybe your friend recommend you the funds? So regardless of why you buy the fund, it is more important for you to know the risk and the strategy of your investment. So by doing rebalancing systematically, it creates a chance for you to review your portfolio periodically. When you see your fund not performing, you might think that is it a global market drop at the same way like what happened in March? Or is it because of the region itself? Then you may consider to adjust your portfolio according to the market attractiveness. So to have more info on market attractiveness, you may read our own in-house research article. Normally, we would have at least 1 to 2 articles every month. Besides, we also provide a facility called Star Ratings at our platform. Our research team will update market attractiveness quarterly. So in our quarterly star rating exercise, we look at key valuation metrics like P and PB ratio, expected earnings growth, as well as the excess earning yield to determine how attractive a particular market is. And in addition, we also consider the economic outlook utilizing both consensus and forecast, as well as our own assessment of long-term economic prospect. So you may do the adjustment according to the star rating every quarter or every year. So for example, if you are a balanced investor, you may invest 50% into equity fund and 50% into fixed income fund. After you read through our article or the star ratings, you realize that we are holding positive view on Asian market at this junction because we believe Asian market has more growth space as compared to local and global market. Therefore, you may consider to adjust your portfolio geographical allocation while remaining the asset class allocation, meaning you still remain 50% in equity and 50% in fixed income. However, you only do adjustment within the 50% in equity. For example, you reduce 5% in Malaysia and global market respectively and add the 10% into Asian market. So by doing so, your portfolio might have a higher potential upside. Okay, now we move on to the next topic, how to choose good funds. Before you learn how to choose good funds, you need to know more about your risk appetite and decide the asset class allocation which is in your comfort zone. After that, you may choose potential markets. From the market, then select the funds with better cost and risk management, as well as greater past year performance. First, we need to know how to choose potential market before selecting good funds. As I mentioned just now, you can go to Star Rating to view the latest respective market attractiveness. By going to Star Ratings, you just need to log in your FSM1 account and choose funds on the top. Then go to Fund Research and choose Star Ratings. After you click on the Star Ratings, you'll be able to see all the data. So at Star Ratings, we not only show you the stars, but also the rationale behind. For example, if you want to invest in an Asian market, you may click on Asia X Japan. Then you can see the reason why we like and why we don't like the market. After deciding the market, you need to know how to do a better fund selection. So when it comes to fund selection, I strongly advise our clients to use a fund selector to filter out the funds. By going to Fund Selector, again, you need to log in your account, choose funds on the top, and go to Fund Info, and you will be able to see the Fund Selector. So this is the surface of Fund Selector. You can filter funds by its asset class, sector, geographical sector, and so on. If you want to view our recommended fund, you just need to tick on the box on the bottom left. This is our recommended fund methodology. When we are selecting recommended fund, we not only focus on quantitative factors such as past year performance, cost management, and risk management. We also look at those qualitative factors. Like we will see the consistency of the fund manager strategy, the stability of the management team, as well as the rate of staff turnover. And not just that, we also take into account currency exchange risk. As we know, most of the funds which invest in other regions are denominated in foreign currencies. So again, in the ringgit Malaysia against another currency may reduce the return of the fund. On the other hand, a drop in ringgit Malaysia against other currencies would increase the fund returns. So as we take into account the qualitative factors, the highest scoring fund based on quantitative assessment in a particular category may not necessarily be the fund we recommend, although fund performance still remains a significant factor. In other words, a highest performing fund may not always be our recommended fund because we do care about several factors. Okay, now let us get back to the fund selector. So in FSM1, we got cooperation with 29 fund houses and we have more than 500 funds to choose. Some investors might find it difficult to do selection. So now I will show you an example to choose a good fund. Okay, let's say we want to invest into Greater China equities. We just need to click on the asset class and choose equity, and at geographical sector, we choose Greater China. Then click on the generate table button. So after you click on the generate table button, you will see the result here. There are total 5 Greater China funds in our platform. So you can see their fund currency, risk rating, latest price, 3-year volatility, their past year performance, as well as our recommended fund at this table. As there are only 5 funds, we just select all and do comparison in chart center. After you click on the compare in chart center button, you will see this result. So in unit trust investment, normally I suggest my client to look at least 2 years time period. So from the graph, you can see clearly that the price movement is almost the same. However, some funds will always outperform others. And let us look at Principal Greater China Equity Fund, the orange color line. This is our recommended Greater China Fund. So in 2-year time period, you will realize that it outperforms others most of the time. So if you are planning to invest into this region, you don't need to invest into all of them. You just need to pick the only winner. Okay, so guys, this is my last slide. If you wish to explore more, you can go to our website and play around with the chart. So today I've shown you the market performance, what is rebalancing, why you should do rebalancing, and how to do rebalancing. Then last, I show you how to choose a better market and fund. So this is all for my sharing. Now we move on to Q&A session. My colleagues and I will filter out similar questions and answer you. After the Q&A session finish, if you still have more questions want to ask, please feel free to email us at investhelp.my@fundsupermart.com. So there's one question asking, what is allocation? So allocation means that if you are a conservative investor, you may invest 90% into fixed income fund and 10% into equity fund. So that's called allocation, the percentage. Okay, there's another question asking on how to set the ratio of equity versus bond in a portfolio. So like what I mentioned just now, before you creating a portfolio, you have to decide how many percent you want to invest into equity and how many percent you want to invest into bond fund. So maybe after 1 year you want to do rebalancing, you have to revert back to the desired allocation. Okay, there's another question from Wong KP. What is the strategy for an aggressive investor? So in FSM1, we normally we normally recommend our aggressive investor to invest 80% into equities fund and 20% into bond fund, because bond fund may act as a cushion when the market is dropping. Okay, there's another question from Fong Kian. He asked, if I doing monthly saving fixed amount in equity fund, shall I do this rebalancing also? So it actually depends on whether you want to do the rebalancing. So I believe you have created your own portfolio. If you're investing in a portfolio way, normally I will strongly suggest my clients to do rebalancing at least 1 year once. Okay, there's one good question from Yoon Ki Hyung. He asking, safe, risk, potential market, is US global market event fundamental very bad. US market uptrend because FED unlimited QE, implement stimulate an economic package, and President Trump election on now 2020. So for midterm investor with RSP plan, should investor balancing portfolio with current market volatility, assume target return 8% per annum, and aggressive risk profile with equity 90% and bond 10%. Yeah, many investors may have this concern. So when the market is dropping, normally I won't recommend our clients to do rebalancing. Instead of doing rebalancing, I will suggest them to do dollar cost averaging. So there are so many investment strategy you can apply. So you need to see the situation according to the market situation. Okay. There's one question from Lee. He asking, how do you track staff turnover of fund manager? No, actually the staff turnover doesn't mean only fund manager, which also include their for example their portfolio team, not only fund manager. So our research team will have a frequent interview with the fund houses. So if we find that the turnover rate is too high, normally we won't recommend you the fund house fund. So for example, like 2 years before, IHB got a significant change in their management team. So at that time, we have removed most of the recommended fund from IHB to other fund house. So there's another question asking, should I include a balanced asset fund into my portfolio? So I believe that you are asking whether you should include balanced fund in your portfolio, right? So normally for balanced fund, right, I would recommend those with small capital investor to invest, because balanced fund, inside balanced fund, it already include equities and bond fund. So you don't need to do so much. You don't need to invest into so many unit trusts. The balanced funds has already well diversified. And there's one question asking, how often should we do rebalancing? So like what I mentioned just now, depends on you. If you think that you do every quarter is better for you, then you can just go for it. And there's another question from Jackie. He asking, what should I do if the fund is making 20% profit? Should I sell or switch into other fund? Okay, again, like what I mentioned, the example I showed you just now, and you may consider to take profit and how to say, to take profit from the 20%, and maybe you can revert the allocation back to bond fund. And there's another question asking, what is the difference between balanced and mixed asset fund? There's no difference. So balanced fund is just mixed asset fund. And there's another question asking, what is the strategy for making sure I buy NAV at its lowest possible rate? So for me, if you really want to buy a fund at the lowest point, I will refer to the greed and fear, greed and fear index. When you see the greed and fear index showing 0, means everyone is panicked, just like in March, everyone selling. But the thing is, do you dare to buy in at that period? Yeah, that's the problem. And there's another question asking, what are the fees for FSM1 managed portfolio? And so basically in FSM1, we got 5 types of managed portfolio. We got aggressive, moderately aggressive, balanced, and moderately conservative and conservative. So five of them got different subscription fee. However, there is one management fee is applicable to all of them, which is 0.5%. So for aggressive managed portfolio, we will charge a 1.25% subscription fee. Moderately aggressive portfolio, we will charge a 1%, and conservative, if I'm not mistaken, is not charging. However, you still need to pay for the 0% management fee annually every year. Yeah, there's another question asking, what about the fees for rebalancing? In FSM1, we do provide a so-called a switching calculator. So if you want to do switching, I think it is better for you to go to our website and use the calculator and calculate the fee incurred. Normally for equity switch to bond fund, there's no cost incurred. And bond to bond, normally also no cost. Okay, there's another question from Andy Gunn. He asking, is it advisable to invest one particular fund house for all the asset class to minimize cost during rebalancing? I think yes. To invest into and to lowering your cost when doing switching. However, when we come to investment, I normally suggest clients to look at their performance and the fund manager strategy. So if the fund is not performing, why you still need to buy into it? Just like the example I show you, the principal Greater China Equity Fund. So we know it is one of the best fund among the fund house. However, it doesn't mean that their Asia fund will performing as good as the Greater Principal Fund. That's why I think because the switching fee is not applicable to all of the fund, I think we still need to focus on the potential growth of the fund instead of the cost. And there's another question from JT. He's asking, is it better if we choose to invest in balanced fund rather than we monitor the market ourselves? Buying or redemption costing us same fees too. So because balanced fund include equities and bond inside. However, the cost is still 1.7%. So normally I won't recommend our clients to invest into balanced fund unless their capital is small. Okay, there's another question. What is the benefit of a managed portfolio? So I think managed portfolio is more suitable for those who prefer hands-off approach. Like maybe they are a teacher or doctor, they are too busy with their job, so they don't have much time to monitor their portfolio. So if they invest into managed portfolio, we got our in-house portfolio manager who actively manage for you. There is one question from Gogin. They're asking, if we write in for assistance on the rebalancing of my portfolio with FSM suggest, will FSM suggest and assist? I think yes, you can just email to us at investhelp.my@fundsupermart.com and our CIS will help you accordingly. Okay, there's one question from Khairuddin Zakaria. He's asking, managed portfolio versus unit trust. So again, if you prefer a hands-on approach, then you may create your own portfolio. like what I say, if you are very busy with your job, I think managed portfolio will suit you the most. There's one question from Chu. He asking, why would you recommend to look at 2-year performance in Chart Center, but not 1 or 3-year performance? So yeah, of course you can look at 1 year or 3 years, but normally I will suggest my clients to look at least 2 years period, because some investor may look at the 3 months period time or maybe 1 month. I think it is not. It may not be really relevant. If you look at the longer performance, then the performance can show the ability of the fund manager. Okay, I think there's one last question. He's asking, where do I see the greed and fear index? This one actually you can just go Google and search, and all the info will show there. Okay, I think that's all for our Q&A session part. If you still have questions, I think you can email us at investhelp.my@fundsupermart.com. Our client investment specialist will reply you maybe on Monday. Thank you very much for joining.